Hello viewers, welcome to my channel. I'm Hashim. So far 12 problems I have completed on partnership. In these problems we have seen what are the adjustments to be made when a new partner is admitted. In the last video, 12th problem, I have explained you how to adjust the capital of old partners according to new profit sharing ratio. Similar points we are going to again repeat in this problem, 13th problem, where old partners capital accounts will be adjusted on the basis of the new profit sharing ratio. So before starting the 13th problem, I expect my viewers to have a printout of the problems which I have given in the link under my description. Always keep it ready. Take the screenshot of the points of this 13th problem, then I'll explain. Now, see the 13th one. The following is the balance sheet of A, B and C, sharing profits and losses in the proportion of 6/14, 5/14, 3/14 respectively. So 6:5:3, that is the old profit sharing ratio of A, B and C. The balance sheet is given: creditors, bills payable, general reserve. Remember, whenever a new partner is admitted, before the admission of the new partner, the old partners will distribute the general reserve, because general reserve represents accumulated profit, past accumulated profit. So before the new partner comes in, the old partners will share the general reserve in the old profit sharing ratio. So A's capital, B's capital, C's capital. These are the capital of the old partners. Now cash, debtors, stock, furniture, land and building, goodwill. The new point. Goodwill is already existing in the balance sheet of A, B and C. So before the new partner comes in, this goodwill should be closed by transferring it to partner's capital account. They agreed to take D into partnership and giving 1/8 share on the following terms. The new partner is D. And what are the terms and conditions? The furniture to be depreciated by 920. We have to decrease the value of furniture. So entry will be revaluation account debit, furniture account credit. The stock be depreciated by 10%. Stock should also be reduced. So entry, same entry, revaluation account debit, stock account credit. A provision of 1320 be made for outstanding repair bill. One unrecorded liability is there, outstanding repair bill, that is not shown in the balance sheet. Now we have to bring it into account. So a new liability is to be brought in. All liabilities will show credit balance. So this outstanding bill is a liability, will credit. So entry will be revaluation account debit, outstanding repair bill credit. And this new liability will come in the new balance sheet. Now, that the value of land and building, now the stock be depreciated. Now that the value of land and building having appreciated to be brought up to 59,850. There is appreciation in the value of land and building. The old value was 45,150. That is the balance sheet value. And the new value is 59,850. The difference is the appreciation value. So entry will be land and building account debtor to revaluation account. Now that D should bring in as a share of goodwill 14,070 and D should bring in 14,700 as his capital. So the new partner is bringing in cash for goodwill as well as capital. And this goodwill will be shared by old partners in the old profit sharing ratio. Now that after making the above adjustments, the capital account of old partners be adjusted on the basis of D's capital to his share in the business. That is actual cash to be paid off or brought in by the old partners as the case may be. Pass the necessary journal entries and prepare the balance sheet of the new firm. The new point here is, after making all the adjustment, we have to find out what is the capital after adjustment for A, B and C. and this should be compared with what should be the capital according to new profit sharing ratio. So we need to calculate what is the new profit sharing ratio and what should be the capital of old partners according to new profit sharing ratio. We'll get the closing capital of A, B and C, and this should be compared with the actual capital they are having in the capital account. So what will happen? The capital may be less or the capital may be more. If the capital is showing more amount, the firm should refund the capital. If the capital account is showing a less amount, then the partner will be asked to bring further capital. Previous problem, in 12th problem, the excess capital was adjusted in current account. But in this problem, it is not asking to adjust in current account. The excess capital should be returned off to the partner. Or if the partner's capital is showing less balance, ask the partner to bring further capital. That is the new point. So before starting the journal entries, we'll calculate what is the new profit sharing ratio and what should be the capital of A, B and C according to new profit sharing ratio. Old ratio of A, B and C, 6:5:3 given in the problem ABC. New partner D, D's share is 1/8. So if 1/8 share is given to D, the remaining share is 7/8. 1 minus 1/8 is 7/8. This 7/8 will be shared by old partners in the old ratio. What is the old ratio? 6:5:3. That is 6/14, 5/14, 3/14. Now what is the new share? New share of A. What is the remaining share? 7/8. 7/8 into 6/14. Because the old ratio was 6/14. So 7/8 into 6/14, it comes to 42/112. Similarly B. 7/8 into 5/14. Old ratio was 5/14. It comes to 35/112. Then C. 7/8 into 3/14. It comes to 21/112. So we got the new ratio of A, B and C. So the new ratio of all the partners will be 42/112 is to 35/112 is to 21/112 is to. What is the D's share? 1/8. 1/8. Here denominator is 112, 112, 112. But here denominator is 8 only. So we should convert it into 112. So how many times we have to multiply 8 to get to 112? 14 times. 14 into 8 will be 112. So multiply the numerator and denominator by 14. So we can convert that 1/8 into 14/112. Now we can easily say the profit sharing ratio is 42:35:21:14. If we simplify, all the values are divisible by 7. 7 6 are 42, 7 5 are 35, 7 3 are 21, 7 2 are 14. That's it. So simply the new profit sharing ratio is 6:5:3:2. That is 6/12, 5/12, 3/12 and it is not 12, it is 16. 5, 6, 7, 8, 9, 10, 16. 6/16, 5/16, 3/16, 2/16. That is the new profit. Now we find out what is the firm's capital, total capital of the firm according to new profit sharing ratio. For 1/8 share, for getting 1/8 share, how much capital brought in by D? 14,700. 14,700 is the capital brought by D for 1/8 share. So what is the total capital of the firm? 14,700 into 8. 8 times. So it comes to 1,17,600. The total capital of the firm according to new profit sharing ratio is 117,600. Now easily we can find out what should be the capital of A, B and C according to new profit sharing ratio. So 1,17,600 into 6/14. 6/16, sorry. 6 plus 5, 11, 12, 13, 14, 15, 16. So 6 by 16. So 1,17,600 into 6 by 16, 44,100. So 44,100 should be the capital of A, right? According to new ratio. Similarly, 117,600 into 5 by 16, 36,750 should be the capital of B. C. 117,600 into 3 by 16, you will get 22,050. This should be the capital of C. So we have ascertained the capital of A, B, C according to new profit sharing ratio. Now we'll start the journal entries. The first entry is regarding the cash brought in by the new partner D. He is bringing in cash for capital as well as goodwill. So how much capital? 14,700. How much goodwill? 14,070. If you add up both, 28,770. The total cash brought in is 28,770. The entry will be bank account debtor 28,770. To D's capital 14,700. To goodwill account 14,070. Narration you have to give being the cash brought in by the new partner. Now this goodwill 14,070, that will be shared by the old partners in the old ratio. In the old ratio, what is the old ratio? 6:5:3. 6 by 14, 5 by 14, 3 by 14. Now, goodwill account debit 14,070, right? To A's capital, to B's capital, to C's capital. In which ratio? Old ratio, 6:5:3. So, 14,070 into 6 by 14, 5 by 14, 3 by 14. We will get 6,030, 5,025, 3,050. Being the goodwill shared by old partners in old ratio. Now, we will make the revaluation. Two assets have to be depreciated, decreased, that is stock and furniture. So, entry will be revaluation account debit to furniture account to stock account. The amount is given in the problem. So, amount given in the problem is the furniture to be depreciated by 920. So, furniture account is depreciated by 920. And stock is depreciated by 10%. So, 2946. 2940, sorry. Stock is depreciated by 10%. So, 2940. So, it comes to 3860. Being the value of furniture and stock depreciated. Next, outstanding repair bill. A new unrecorded liability should be brought in. Revaluation account debit, outstanding repair bill credit, 1,320 given in the problem. 1,003. Being an unrecorded liability, now recorded. Now, land and building are to be appreciated, increased. So, entry will be land and building account debit, revaluation account credit. How much? Take the difference. 59,850 minus 45,150. You will get 14,700. The new value is 59,850. Old value is 45,150. Subtract this. Being the land and building appreciated. Now, general reserve. The general reserve balance is 10,500. This will be shared by old partners in the old ratio. The entry will be general reserve account debit 10,500 to A's capital, to B's capital, to C's capital in this ratio. 6 by 14. So 10,500 into 6 by 14. 10,500 into 5 by 14. Then 10,500 into 3 by 14. We'll get 2,250. Being the general reserve shared by old partners. Next is the goodwill. Existing goodwill. Before the admission of the new partner, if goodwill is existing in the balance sheet, that goodwill should be closed by transferring it to old partners. The goodwill account will show debit balance. Now, if you want to close, credit. The goodwill account should be created by 5,250. A's capital debit, B's capital debit, C's capital debit. A's capital account debtor, B's capital account debtor, C's capital account debtor. To goodwill account 5,250. Now we have closed the existing goodwill. Now goodwill will not appear in the balance sheet. New balance sheet will not appear. Now in the old ratio, 6:5:3, we have distributed. Being the existing goodwill closed by transferring it to old partners. Finally, we have to find out whether there is profit or loss on revaluation. That profit or loss will be shared by old partners in the old ratio. For that, we need to prepare revaluation account. So after passing up to 7 entries, don't pass 8th, 9th, 10th entry. We have to see the situation and then we have to pass the entry. Revaluation account. Here revaluation account is debited to furniture to stock, to furniture to stock. Then revaluation account is debited outstanding repair bill, outstanding repair bill 32. And revaluation account is credited land and building, so land and building 14,700. Credit side is more, so 14,700 minus 920 minus 2940 minus 1320. So profit is 9520. 9,520 is the profit. And this profit will be shared by the old partners in the old ratio. So A will get 9520 into 6 by 14. This is the old ratio. 6 by 14. Then 9520, 5 by 14, 9520, 3 by 14. So 4,080 is the share of profit for A, and 3,400 share of profit for B, and 2,040 is the profit for C. Entry will be revaluation account debit 9,520. Here you can see revaluation account debit 9,520 to A's capital, to B's capital, to C's capital. These are the capitals. Being the profit on revaluation shared by old partners in the old ratio. That's it. Now, the remaining 2 entries we need for cash adjustment of the partner's capital. The partner's capital should be, A should have 44,100, B should have 36,750 and C 22,50. Now we have to see how much capital they are having in their capital account. The present capital of accounts of A, B and C. See here, old balance. The old balance of A is 35,400. So here I have taken 35,400. A. To this we have to add. See where the capital account is credited. In the second entry, A's capital is credited by 6,030. That is nothing but goodwill. A is getting goodwill 6,030. Here I have taken 6,030. Then next, A's capital is here. A's capital is credited 4,500 for general reserve. The general reserve 4,500 is getting. Apart from that, A is getting share of revaluation profit. How much is the revaluation profit? 4,080. And lastly, A will share the existing goodwill. Existing goodwill was 5,250. Of which how much is debited to A? 2,250. A's capital account is debited. When capital account is debited, it will reduce capital. When capital account is credited, it will increase capital. So here it was credited, so we have added. Here it is debited, so we have to subtract. So 2,250 we have to minus. Here minus 2,250. So what will happen? A's capital, after making all adjustments, we are having 47,760. Similarly, opening capital for B, 29,850. Here I have taken 29,850. Now he is getting goodwill, 5,025 goodwill. Apart from the general reserve, 3,750. And then he is getting share of profit, 3,400. Existing goodwill share is 1,875 minus 1,875. So B's capital. B's capital is showing an amount of 40,150. A 47,760, B 40,150. Similarly C. The existing capital of C 14,550. To this goodwill 3,015. Then share of this is reserve 2,250. Share of profit 2,040. Existing goodwill share 1,125. So presently 20,730 is the balance in the capital of C. So now partner A. Required capital is 44,100. Here we have calculated. A's capital should be 44,100 according to the new profit sharing ratio. But presently, how much capital he is having? 47,760. Presently, he is having 47,007. So his capital should be 44,100. But his capital account is showing 47,760. Excess capital. Therefore, the firm should return back an amount of 3,660 to Mr. A. The firm should return to partner A 47,760 minus 44,100. 47,760 minus 44,100 will get 3,660. This is the amount firm should return it to A. Similarly, B. Required capital for B is 36,750. Here we have calculated according to new profit sharing ratio. But his capital is showing 40,150. Again, B is showing excess capital. Instead of 36,000, 40,000 is having. The firm should return back to B. How much the firm should return back to B? 3,400. So there is a refund of capital to A as well as B. Now C. The C's required capital is 22,050. Whereas how much capital its account is showing? 20,730. That means C's capital is showing less balance. The firm should ask C to bring further cash. So how much cash C should bring? Partner C has to bring cash for an amount of 22,050 minus 20,730. 1,320 cash has to be brought by C. Now we have to pass the entries for this excess cash returned. To whom excess cash returned? A as well as B. So entry will be A's capital account debit. A's capital account debit. B's capital account debit to bank. Right? So how much excess capital returned to A? 3,660. How much excess capital returned to B? 3,400. The total cash excess capital return is 66 plus 4, 10. 3 plus 3, 6, 7. 7,060. Being the excess capital returned back to A and B. Now C has to bring cash. So the firm is getting cash. So the entry will be bank account debit to C's capital. To C's capital. How much C has to bring cash? 1,320. 1,320. Being cash brought in by partner C. That's it. Now we find out what is the balance in the bank account. In bank account, first we are given bank or cash, 1,890. Right? So it is given cash, bank or cash. So 1,890 is the opening balance of cash. So balance brought down 1,890. Now see the entries. Wherever bank is debited, we take it on the debit side. If bank is credited, take it on the credit side. Here first entry, bank account debit. So bank account debit, D's capital 14,700 and goodwill 14,070. So this is the opening balance, 14,700, 14,070. Right? Now again see where bank account is debited or credited here. Here bank account is credited by A's capital, by B's capital. By A's capital 3,660 and B's capital 3,400. That's all. And last one, bank account is debited to C's capital 1,320. Here 1,320. So we have posted all the entries in the bank account. Now simply find out the balancing figure. What is the balance? So here debit side, if you take the total 31,980. 31,980 minus 3,660 minus 3,400. 24,920 is the bank balance or cash balance after making all adjustment. Now this balance will appear in the balance sheet. That's all. Now finally we have to make the balance sheet. By seeing the old balance sheet, we can make the new balance sheet. Old balance sheet, creditors 18,900. We have not changed. We have not passed any entry for creditors. So same 18,900. Bills payable 6,300. No change at all. 6,300. But here general reserve, it will not come, because general reserve are already shared by the old partners. New liability has been brought into accounts. The new liability is outstanding repair bill. That was not there in the balance sheet, but we have passed the entry. A new liability, outstanding repair bill 1320. Outstanding repair bill 1320. Now capital of A, B, C, D, all partners, including the new partner. So A, B, C, D, the capitals are here. A's capital 44,100 according to new profit sharing ratio. B's capital 36,750, C capital 22,050 and D's capital is 14,700. Same capitals are taken. Now asset side, cash. Here cash balance is 24,920 in this bank account, cash account. Then debtors, no change in debtors, same 26,460. Stock value was reduced to 940, 29,400. Actually, it is written as 29,460. It is not 29,460, it is 29,400. So 26,460, right? Then furniture, 7,350 minus 920, 6,430. Land and building has been appreciated. So 45,150 plus 14,700. Here 14,700 we have increased here. 14,700 add. Then 59,850 is the new value of land and building. That's it. Now find out the total on the liabilities and assets. The liabilities side 1,44,120. Asset side 1,44,120. That's all. Balance sheet tallied. So this 12th problem and 13th problem are similar. That means adjustment of old partners' capital according to the new profit sharing ratio. So this is the end of problem number 13th. Inshallah, we'll take up the next problem, problem number 14 in the next video.